PFR Nation, Kevin Lau here, host of the Planning for Retirement podcast. And I'm super excited to be back on the whiteboard for this fireside chat, latest fireside chat. Been in a little bit of a hiatus. My family and I, we just moved from our rental. We were renting a property in Chattanooga when we first moved here, and now we are in our long-term home. Super excited about that. But it's been a little bit of a bear prepping for the move, and we also had some travel going on in April and also in May. So just decided to take a little bit of a pause. If you listen to the podcast, you knew this. But if you don't, I apologize and should have done a specific YouTube video letting you know I was going to go on a little bit of a hiatus for the Whiteboard Fireside Chats. But if you're not subscribed or follow to the podcast, make sure you do that on Apple, Spotify, or wherever you consume podcasts. We love to put out our weekly retirement-related content. And this one is sort of a kind of a pivot off of episode 80 on the podcast, which was essentially 6 ways to pivot if you are feeling a little bit behind on your retirement goals. And so this particular example that we're going to jump on the whiteboard is for Jack and Barbara, and they are currently 61. They're about to be 62, and their goal is to retire at 62. And we're going to look inside of their current plan, and we're going to kind of give you a sense of, okay, how are they tracking now for their goal? And given their sense of, hey, you know what, that's given them a little bit of anxiety. They're kind of borderline funded, if that makes any sense. So they're borderline funded. What levers do they have to pull? And so as we talked about on the podcast, go back and listen to that if you missed it. But two of the levers they can pull are, number one, take on more risk, or number two, work another year or work longer in a sense. And so both options are on the table, and we're actually going to go on the whiteboard and show you which one actually moves the needle more for Jack and Barbara. And then I'm going to ask you, PFR Nation, what would you choose if you were sitting in their shoes, if you were Jack and Barbara? So why don't we dive into the whiteboard here? And first, we're going to start just with a high-level summary of their goals. So as I mentioned, their goal is to retire at 62. They need approximately, on an after-tax basis, $8,000 per month for their baseline expenses. We also built in a little buffer for healthcare costs. Okay, this is the average for retirees over 65. Typically spend a little over $6,000 a year per person. So if you add both Jack and Barbara's up, that's a little over $12,000 a year, or just over $1,000 per month. Okay, so that's a factor in addition to their $8,000 monthly expense. And then the fun stuff down here, as you can see, travel, vacation, we built in this buffer for 15 years. This is really their go-go year funding. So you've heard us talk about the go-go, slow-go, no-go years. So when they're 62, they don't know how long they're going to be in Superman, Superwoman health, but they want to travel as much as possible and really maximize their life experiences in that early phase of retirement. So we're going to add this additional $15,000 a year, or a little over $1,000 a month, on top of their regular expenses as well as healthcare. As you can see, looking at their balance sheet, they don't have a mortgage, so awesome, no debt. Maybe some recurring credit cards, but nothing standing that is on their balance sheet as a liability. And if you look at their assets, they've got their emergency fund, very, very comfortable emergency fund. They have over 6 months of expenses in cash. So they're feeling very, very comfortable on that. And then now we're living on their retirement portfolio, which is just shy of $2 million. They've done a really good job saving and investing. The makeup of that, just to kind of pull back the curtain a little bit, is about $650,000 is taxable. So, maybe I would call this non-qualified. And then the remaining $1.3 million is all in tax deferred. Okay. So they don't have any Roth at this point in time. This whiteboard fireside chat is not going to talk about whether or not they should be doing Roth conversions. That's going to be reserved for more of maybe a formal whiteboard retirement plan breakdown or a podcast episode. But just high level, 1.9 million, just over 1.9 million of investable assets. And what we're going to use is we're going to use our financial planning tool. We're going to run them through the Monte Carlo simulation and say, okay, here's what their goal is for cash flow. Here's their investable assets. They do have Social Security payments coming in, which will be at full retirement age, which is going to be 67 for both of them. It'll be a little over $4,700 per month. So a nice little baseline, but they have a 5-year bridge. Okay, so this bridge from 62 to 67, where they're going to be relying solely on their investment portfolio. They have no pensions, and then at 67, then their rate of withdrawal will go down a little bit, and they're going to supplement that Social Security income with withdrawals from their investment portfolio. They are kind of your prototype investment allocation, your standard balanced portfolio, the kind of the tried and true 60-40 portfolio. Not saying this is right or wrong. And you've heard me talk about on the podcast before, and even these whiteboard fireside chats. One of the mistakes I oftentimes see early retirees or new retirees make is they get too conservative too early on. Okay, they load up on too much on the fixed income space. And this fixed income space is great for that stability. Well, mostly for stability. Over the last 2 to 3 years, haven't been very stable. Okay, interest rates, as they go up, the value of bonds go down. So that's really hurt a lot of folks that have been too conservative. Is your bonds in 2022 return negative 13%. So far year to date, not doing so hot. Okay, so fixed income, generally speaking, provides that nice stability, but it does lag inflation slightly depending on what type of bonds you own, or maybe just matches inflation long term. So maybe 2 to 3% rate of return, whereas equities will be that inflation hedge. So that should, I'm not going to say it will because it's not a guarantee, but it should exceed inflation over the long run. Now, they are the standard portfolio 60-40, and one of the considerations is, should they take on more risk in their portfolio in order to achieve their goals, or give them a little bit more of a surplus, or should they continue to work another year? And the reason we're having this discussion is, if you look at the rate of withdrawal, in the beginning, in that gap, so that bridge from when they retire, and draw bridge here, this is their bridge to Social Security. Bridge to SS. And my handwriting, not very good, but it is what it is. So it's over 6% in the early years, which okay, that's fine. That's not going to break the bank. It's not like they're going to be over 6% for 20 to 30 years. And that is one downside. We talked about this before with the 4% rule and Bill Bengen, mentioned this at, multiple times, is that it does not factor in other cash flows. You're just talking about withdrawals from the investment portfolio. So in this case, they're going to have Social Security kick in, and then they're actually going to be below 4% for quite a while. And inflation over time will cause that rate of withdrawal to go up, as well as required minimum distributions, which for them will begin at 75. This will be RMDs. Okay, so RMDs does make the rate of withdrawal go up over time because the life expectancy factor goes down, and therefore the amount you need to withdraw goes up. Okay, but it's okay. The bridge, just over 6%, and then it drops down to below 4%. That's a pretty good spot to be. So on the surface, this plan looks decent to me. Okay, but let's run it through the stress test. Let's run it through the Monte Carlo. Okay, so what you're looking at is this probability success number, and for them it's 79%. Now, for those of you, PFR Nation, that are high achievers and overachievers, you're probably thinking, no, you want an A or an A plus. You want to be 90% or above, which, not saying that's right or wrong. I'm just saying, generally speaking, 79% is actually a pretty good place to be, especially for individuals that may not be super concerned with maximizing what's left over to the next generation. But maybe you are. Maybe you do want to preserve the majority of your principal and you want to leave this to the next generation. Well, in this scenario, maybe it's your kids, or maybe it's a charity, grandkids, whatever it might be. In this scenario, the 79% probability of success, what this really illustrates is the number of trials within this Monte Carlo simulation. So the Monte Carlo is basically a fancy term, a mathematical statistical term that basically takes into consideration a certain variable or multiple variables and runs it through the stress test. In this case, we run 1,000 different iterations of the plan. And in this case, we're stress testing rate of return, because when no one has a crystal ball, we don't know exactly what type of markets you're going to retire into. If you looked at someone who retired, in 2000 to 2010, not a great start, because we had the early 2000s dot-com bubble, we had 08, 09, the Great Recession. So versus someone who, let's say, retired in 2012, 2013, just after the Great Recession, they went through a 12-year period of a substantial bull run. So feeling pretty good about that. But we don't know. We don't know what the market's going to look like when you specifically retire. That's why the Monte Carlo is a good starting point. I don't like to use it as the be-all, end-all, and I certainly don't like to go overly conservative with this percentage. Again, especially if the goal is not to maximize legacy or financial legacy at death. Maybe it's to maximize experiences in retirement, or maybe it's lifetime gifting to your kids as opposed to maximizing what's there at the end. So 79% is actually a pretty great starting point. But 1.4 million, as you can see, this number indicates the median trial. So we run 1,000 different trials. This is the median trial, so the 500th trial. So not the overly pessimistic scenarios and not the overly optimistic scenarios. So 1.4 million, if you compare that to their investment portfolio today, just about 1.9, you might be thinking, hey, that's pretty good. They didn't maintain all 100% of the principal, but they were pretty close. Now, what I will say is, right here, this is future dollars. So if you really take a present value into account, depending on what inflation might be, this might feel closer to maybe $500,000, $500,000, or maybe $600,000 in today's dollars. So really their portfolio adjusted for inflation actually went down over time. And they are in that mindset. They are overachievers, and they are warriors too. They want to make sure they have a little bit of a buffer, to pass on as a legacy, but also to protect against the unexpected risk, like a long-term care event down the road. They don't have long-term care insurance, or to pass on to provide that buffer just in case one of them lived past 90 or 95 years old. They want to make sure they have some assets there as a buffer. So this made them feel a little bit uncomfortable. So now they're kind of thinking, okay, do they work longer? Do they spend less? That's another lever they can pull, but they don't want to do that. They want to maximize enjoyment during retirement, but they could also take on more risk. And so we're going to then compare both scenarios to see what impacts the Monte Carlo more, from a percentage standpoint, but also from a median ending capital standpoint. That's this number here, this median ending capital number. Okay. Or in other words, what is the surplus? What is the buffer at death? Okay. Now, another, the probability of success, I definitely I do have an issue with this terminology. I think a better way to frame this is actually the percentage of probability where they never needed to make any adjustments in their plan. Okay. I think that's actually a better way to frame up this Monte Carlo simulation, is that 79% of these trials, they never had to make any adjustments at all. Whereas the other 21%, I should say, they did have to make an adjustment. Now, how drastic that adjustment is or would be in the future, we don't know. I mean, we don't know, specifically what the market's going to do. And so, we do like to use that guardrail framework in our practice, where if the markets did something to your portfolio that caused your rate of withdrawal to go up dramatically, meaning your portfolio dropped and therefore the amount you're taking out as a percentage goes up substantially, maybe you do make an adjustment there. Okay. So guardrails is a nice framework, but only 21% of those trials do they need to make some kind of adjustment. And I think that's very important because, if we went through a scenario in this 21%, let's say like a Great Depression. Okay. If we're in a depression type era, you're probably not doing those go year travel excursions anymore. You're probably really hunkering down. You may not even be spending what you're normally spending, from a lifestyle perspective. So we have the flexibility, and you have the flexibility as a retiree to make adjustments over time. And that dramatically impacts this Monte Carlo simulation and ultimately what is going to be left over at the end of your death. And so, again, it's a starting point, the 79%. Now let's compare it to some of those variables that we mentioned, some of those levers they can pull. And we're going to start with increasing risk in the portfolio. So let's say they went one notch up. Okay. And so from our perspective, going one notch up would go from moderate or balanced over to moderately aggressive. So not overly aggressive, but moderately aggressive. So really, in other words, this term, the way I would frame this up is increasing your equity exposure. Increasing your equity exposure will increase your risk. In other words, portfolio volatility. Okay. So when things are bad, you're going to experience more of that being a little bit more aggressive. Okay. But long term, we're going to experience a higher expected rate of return. So because of that added volatility, you should be compensated for that additional risk. So this does have an additional rate of return, not substantial. Okay. Not a substantial additional rate of return, maybe 40 basis points over and above the current asset allocation. And let's see the impact on the Monte Carlo simulation. So as you can see, it goes from 79% to 80%. Okay, so it did move the needle slightly positive, but the big thing, the big change, as you can see here, that median ending trial goes from 1.4 million to just north of 1.8 million. So it provides them an additional surplus of just over $300,000, $370,000 roughly, an additional ending capital in that median trial. So that could be used to provide a buffer for long-term care costs. That could be used to provide a little bit of an inflation or longevity hedge in case they lived a little bit longer, or it could be passed on to their children. Okay, so right away on the surface, increasing risk not only improved this Monte Carlo number, but it also improved the amount that would be left over at the quote unquote at the end of the plan. Okay. And this probably surprises a lot of people, as a lot of people would think, hey, the more risk you take in a portfolio, probably the higher probability you would need to make an adjustment. But actually, that's not the case. It actually improves the probability of success. And there's no set answer on this one. Every plan is different. All of your plans are going to be different because you have different income sources, different sources of income that are guaranteed and non-guaranteed. Your investment portfolio looks different. Tax scenarios look different. Your RMDs are going to look different. So I'm not going to say this is going to be true for all of you, okay? But I'm saying in this particular plan, slightly increasing the risk does move the needle positive, both on the Monte Carlo and both on and the ending capital scenario. Okay. Just for fun, I went one notch above and I said, so what if we went two notches above? So 60% equities up to 85% equity. So this would be a dramatic increase in the expected rate of return because you have a dramatic increase in the amount of volatility you have. Let's look at the Monte Carlo. The same. Okay. So we're tied there in the Monte Carlo impact, but now look at the ending capital number, 2.1 million. So now we're talking an additional $700,000 of a buffer over and above the current plan using that 60-40 model. Now, what I would say is, from my experience as a practitioner being in business for 17 years, is that as you go into retirement, generally speaking, your tolerance for risk goes down because you're not relying on employment income anymore. It's passive income from your investment portfolio. But it also kind of depends on how much income you have that are guaranteed sources. If you have a Social Security and pension, maybe you have more tolerance and capacity to take on more risk, but maybe the majority of your cash flows are coming from your investment portfolio. It may not feel very good for your portfolio to be going up and down dramatically with the markets. So 85% in equities may not be appropriate for a lot of you listening or watching this video, but for some of you, it could be. And so, being an aggressive portfolio could be viable for some of you. Okay. And furthermore, another thing to think through is this concept of asset location. So maybe 85-15 is your target, but maybe you plan to tap into that brokerage account first, your taxable account first. Maybe that account is, a little bit more conservative. Okay. But so maybe, the trust account is conservative, and then those IRAs are more aggressive. Okay. So you can kind of bucket your accounts based on the timeline of when you're planning to make withdrawals. That could give you a little bit more peace of mind to be more aggressive overall, because if you combine this with this, that gets you this 85-15 portfolio. Again, I'm really oversimplifying things, but that is a scenario that I believe also adds value from a behavioral investment standpoint, is this concept of asset location. Okay. So, again, to summarize, increasing risk improves the Monte Carlo going one notch up. The Monte Carlo is the same going two notches up, but in both scenarios, increasing risk improves the ending capital amount left over at death. Well, what about working longer? Okay, so again, they're right now they're 61. They plan to retire at 62. What if they pushed retirement back just 1 year for both of them? Now, for some of you, this may not be palatable. You might be like, hey, I'm done. I cannot work another year. I'm finished. But it can also be, and we talked about this on the podcast, maybe it's working part-time or doing something different. Those are viable options too. But look at the Monte Carlo impact by just pushing back work 1 year. We've improved the Monte Carlo by 10%. That is substantial. Okay. So we have life expectancy going down, portfolio withdrawals going down. This dramatically increases that probability of success, again, by 10%. And look at the ending capital number, 2.1 million. So that takes care of that $700,000 buffer right there. So this is staying as a 60-40 investor. So this scenario, we're still 60-40. We're still balanced. This basically solves for that additional buffer they may want to have for those long-term care costs, legacy goals that they have for their children. What if they did both? What if they went one notch up and went to a 72% equity portfolio, 28% fixed income, and plus 1 more year of work? Okay. Now this one, the Monte Carlo, don't ask me what the scenario is here, but the Monte Carlo didn't improve by as much, but it improved that ending capital number quite dramatically. So again, it's one of those things to look at. These are levers you can pull in order to improve your probability of success, improving your probability of achieving your goals, giving you a little bit more of a cushion, a little bit more of a buffer. But my question for all of you PFR Nation, if you were Jack and Barbara, what would you do? For me, it depends on how much I'm liking what I'm doing. For me, right, if you were asking this question, I'd probably work another year because I enjoy what I'm doing. Why not do another year, right? Or maybe I scale back. Maybe I work part-time, so therefore the rate of withdrawal is a little bit below 6% for a period of time, and then Social Security kicks in, and then maybe I start full retirement at that point in time. But that's a lever I can pull. I'd also probably step up my risk. I do have a higher risk tolerance. Maybe it's because of my age, but 60-40 probably is a little bit too conservative for me. So I'd at least go to that moderately aggressive portfolio. But you may not be thinking the same. So I'm curious about you, PFR Nation. Which one would you choose and why? Drop it in the comments below in the YouTube video, and make sure to subscribe and like the video if you're finding value in our content. Make sure to like it, make sure to subscribe, and also make sure to share this with someone else that you believe is a PFR Nation caliber type of individual, someone that's over 50, they're nearing retirement or recently retired, and they're overachievers. They've already exceeded 7 figures of investable assets, are looking to make work optional, looking to fire their boss, travel, play more golf, do the things that they want to do when they want to do them. And I think they would also find value in our YouTube channel as well. So that's it for this week. Thank you for tuning in. Thank you for your patience during the moving process. And truthfully, this might be one of the last whiteboard fireside chats I do in my office here. I've got a nice little home office set up that I'm really excited to continue to get situated. Okay, we've got a lot of other things that we need to unpack and boxes to unpack. So we've got a lot of house prep work to do, but the office is definitely at the top of the priority list. But there might be another 1 or 2 whiteboard fireside chats I'm going to be doing from my office here in my physical location downtown, and I might be transitioning a little bit more to my home office. So, but thanks for all your patience over the last few weeks during this hiatus, and until next week, this is Kevin Lau signing off.